So let's get started here. The current situation, the culmination of a long series of kind of events, or you can call them mishaps if you want to. First, of course, was the big shift in costs. Started in 2007, really driven by biofuels policy, bringing ethanol in as a big user of corn. That's still having an impact. We still haven't got all the adjustment made to that. We're in the process of making it. Now we've got some other things to worry about, but that's still one of the things that's certainly impacting the beef business. The recession of 2009 and 10, of course, had some real profound impacts, especially on the blend of food service and retail split. Of course, drought conditions, the beef industry has had drought somewhere for the last decade, and they've had some drought conditions in real important cow-calf areas for the last 5 years, especially in 2011 and then 2012 in the upper northern plains. History finally caught up with us. Elwin talked a little bit ago about we hadn't had a drought in the United States, a real big one, since '88. We were living on borrowed time, normally about an 18-year cycle. It took 24 years to get one this time. We finally had a drought in 2012. And of course now, kind of an out of the blue, a one-off situation, a PEDV comes to the United States and impacts the hog supply. So all of these things are having a big impact. Grain prices and costs. You know, to paraphrase one of my great favorite singers, Merle Haggard, are the bad times really over for good? I think they might be. I mean, I think we got most of this bad high cost behind us. We do have some considerable risk, but if we look at the drop in corn and soybean meal prices relative to recent history, pretty dramatic fall in that. Corn has gone down more than soybean meal. Not great for us, but really provides us some advantage on chicken there because their diets run much higher percentages of soybean meal, and it's one of the reasons they haven't been able to react this year as much as we thought they would to these market conditions. I think planting risk and soybean competition premiums are kind of out of the market on corn at this point. There's still some weather risk there, but if we look, these futures in the 430 to 455 range, somewhere in that range for new and old and new crop corn, you know, pretty reasonable kind of prices relative to where we've been. If Elwin's above average 169 yield comes through, I think it's likely you're going to have some corn right around $4 and maybe starting with a 3 at harvest time. That would be a very real possibility. Costs, of course, very high. 2013 record high at $93.95 per hundredweight carcass. This is based on the Iowa State University estimated costs and returns. Significantly lower now, right around $82. That number was lower than that earlier this year before we had this rally in corn as we went through the spring. Right now, the futures say next fall in the high 70s for production costs. So, we've certainly got a better situation on the cost side. And if we compare that to what's going on prices, of course, a pretty positive situation for producers. The corn deal. A lot of the kind of my comfort with the corn situation is the fact that the world corn supply situation is much better than it was. Record high production, record high consumption, but the highest stocks that we've had in 12 years on a worldwide basis. Now, a big reason for this is that when we decided to do some things to jack up the corn price here, guess what happened? We attracted a lot of competition. There's almost 50% more corn grown outside the United States now than there was in 2004. In 2004, we grew it looks like the band's coming back. In 2004, we grew the majority of the world's corn. Now the majority of the world's corn is grown somewhere else. There was a lot of hand-wringing last year among some people about importing corn from Argentina. And I told them that was only really a problem because they assumed that North Carolina was part of the United States. And I was joking, I really was. But the point is, political affiliation is not the important thing when you talk about where these products are going to flow. Economic situations are. North Carolina's always been a corn deficit area. It just normally imported its corn from a country called Michigan. All right? Last year, the price situation was such that you could bring it from South America. And this growth of non-U.S. production means that's going to happen more often. We used to not have that counter-seasonal crop of corn from the southern hemisphere that we've had in soybeans. And so this is going to happen more often. We're bringing soybeans into the United States again this summer. That's going to happen. We need to be ready for that and expect it. It's really a good thing because it gives us a counterbalance on our costs here in case we have a short crop. On the soybean side, record high production, record high consumption, but unlike corn, we have record high soybean stocks, and yet we still have old crop soybeans $14.50, and we've got new crop beans well over $12. And so we're sitting out here with very high stocks to use ratios and still have record prices. And the reason is demand is really strong, and the key issue on that is China. China has a seeming unending appetite for soybeans. We need more production, and so what's happened is we're going to have record acres on soybeans. We have a slight reduction on acres in corn, but it's the 4th or 5th largest acreage, at least intentions, that we've had on corn. The pace of planting tells me that we're probably going to get most of those corn acres planted. We don't have any big areas of prevented planting that I'm aware of like we did last year in northeast Iowa, southeast Minnesota. And so we're going to get those acres of corn, and the pace at which we've got the soybeans planted, there's still time to plant soybeans in a lot of places. I think we're going to actually probably get a little above the intentions on soybeans this year, very possible. So we're in good shape on that. If we look at planting progress, of course, everyone was wringing their hands a few weeks ago about the cold spring and saying, oh man, we're just never going to get to trend yield. And I heard one guy say we're going to have $6 corn this fall, and I'm going, boy, this is really early to start deciding that. And as it's turned out, it was very early. We've made up that ground on planting. The condition of this corn is great, 80% emerged, right on the average, 76% good to excellent compared to a normal for 63%. We look at the bean side, we got 50% of the beans emerged. That's above normal. We don't have any crop condition ratings yet on beans, but I suspect those are going to be very positive. We did have some hail damage in some areas the night before last here in Iowa. All I would say is we always have hail damage somewhere to the crop in the United States at some point, and I'd rather have hail damage this first week of June as I would the first week of August, because there is some chance to get some kind of a crop off those acres regardless. So we look at the supply and demand estimates from USDA. Of course, May was their first estimates for this year. They had a trend yield of 165. 13.9 would be a record corn crop. Usage numbers very comparable to a year ago. A slight reduction in exports. A big increase in carryout stocks from 1.14 billion bushels up to 1.7. Stocks to use ratio goes up to 12.9. And USDA's midpoint on their price situation right now would be at $4.20 per bushel. I think that's a pretty reasonable kind of estimate given where we are. Here's the recent scatter diagram of price versus stocks to use ratio. You can see we had this massive shift in about 2007 and 8 up to this much higher, much more inelastic line. I mean, you have a little bit of a change here on the corn crop, and it has a much bigger impact on price than it once did. So this year, right now, USDA's forecast, it looks like they stole my chart. It's right on the line that I'd put on my chart last fall as kind of representing the corn demand for this time. On the soybean side, obviously they still have trend yield here. As Elwin told you a while ago, if you got above trend yield corn, you're probably going to have above trend yield beans, and we need every bushel. Notice this carryout right here of 130 million for this summer. That is the tightest we've been. Even over the last several years of bad crops, this is tight, tight, tight. And so this is going to get very explosive this summer. If you don't have some things done on soybean meal, you need to get that done. And it might be kind of too late, but I think you could be in better shape than if you try to wait and buy spot meal as we go through July and August. Next year, though, if this all comes to fruition, a dramatic increase there and probably some reduction of soybeans. USDA has them 975 to 1175, of course 1075 the midpoint. Again, an above trend yield. We very well could have beans below $10. Now, does that mean soybean meal is going to be cheap? Not necessarily. And the reason is that oil is not carrying much of the value proposition on this soybean crush, and it's probably not going to in the future. I was at the Soesland purchasing seminar on Monday, and heard a guy talk about veg oils, and I don't follow all the different veg oils. There's a gazillion veg oils in this marketplace, but the most important one is palm oil. There was some speculation that a shift to El Nino would really hurt the Malaysian and Indonesian palm oil crop. This analyst did not think that was going to happen. He thinks the supply is going to be very good, and plus you put that in, plus all the concerns we have now about trans fats and stuff, and just soybean oil probably isn't going to carry any more of this value proposition next year than it has this year. Now that means that instead of $450, $500 a ton bean meal, we could probably have it down in the threes, but I don't know that we're going to get any farther than that. This is the real issue in the short term, though. Watch out for bean meal. I don't know exactly. I should have corrected these numbers. Obviously, last summer, the summer before, we traded up above $550 a ton on cash meal. We've seen this running up in recent weeks again. I wouldn't be surprised to see it get well above $550 before we're done this summer. I heard a guy make an argument for $650 or $700 bean meal by August. So if you don't have that covered, that's something you ought to get done, or at least do something to try to cover your bases. Questions about grains? We're not going to talk much more about them, but we'll stop and take a question or feed costs. Looks like we're going to be in a good situation on feed costs. Now, with that said, as I tell people, if you had the top 20 things that determine the size of the crop, rain the third week of July would be number one, rain the second week of July would be number two, rain the first week of August. I mean, there's a whole lot of things that are ranked above when do you get it planted. So there's a lot of things that could still go haywire. The forecasts are very good. You heard Elwin. I talked to Drew Lerner earlier this week, one of the real respected meteorologists. He thinks we're going to be in great shape in the Corn Belt as well. Yes, sir.
Steve, you mentioned those prevented planted acres of last year, and some people think there were some phantom acres that possibly didn't get counted in last year's report because of all the voodoo of those acres. When we come to the end of this month and have a new report from USDA, do you expect an increase in corn and bean acres, or just?
Oh, he's asking about prevented planted relative to intentions or relative to last year? Well, I think we'll get the acreage report, the actual acreage report at the end of June. As I said, based on the timing that we've had so far and the progress reports we've had, my guess is that we're going to virtually hit the planted intentions on corn. I think we'll probably not go much past that, even though we got it planted pretty well, okay? So, and still in the Midwest, if you can plant corn, you're going to plant corn, okay? Now, this price relationship between beans and corn certainly has favored beans to some degree this year, but my guess is we're going to just about hit the intentions on corn. We're probably going to go past the intentions a little bit on beans. That's my guess at this point.
Any guess on acreage or in terms of how much better?
Oh, not 1 million acres, though. I mean, there's just not that much out there. If you get all the corn planted, there's not a lot of acres available, okay? Now, how much double cropping will you get south of here? That depends, too. And so we never know kind of how to count that. Demand. We got a great market, partially due to short supplies, but I'll tell you one of the reasons is demand. And we're not, I won't say we're not sure why, but some of the things that normally drive demand, like consumer incomes, like a stronger economy, are really pretty iffy. If we look at the economy, this is GDP, quarter-to-quarter change. We can see that in the first quarter of this year is actually lower than the fourth quarter of last year. If we look at it in a year-over-year change, this is comparing one quarter to the same quarter a year before, you can see that the rates of growth since the recession have not been very good relative to what we were doing before the recession. We're only running along at 2.5% on growth, and most of the forecasts are not much better for that next year. So we don't have a rapidly rising income situation. We've added some jobs, over 200,000 the last 3 months, and almost 300,000 in April. That's good, but again, we still haven't made up for the hole on that. The unemployment rate down to 6.3%. That's good. But if we look at the U6 rate, which includes partially employed and part-time employed, underemployed people, it's still at 12.3. That was at 14 here in the worst of the recession. It was at 10 back here before the recession. So we're nowhere near recovered on the number of people with full-time jobs that we would consider fully employed. We look at real per capita disposable income, which is kind of the take-home pay variable macro. It's after taxes, okay? We can see that before the recession, that was growing at an average, a lot of variability, but an average of 2%, a little over 2%. Since the recession, the average has been 0, okay? We had a pretty good month in January, almost 2%, but it's been 1.4, 1.3, 1.2 the 3 months since then. Nothing robust here. People don't have a lot more money to spend, so you wouldn't think that demand would be terribly strong, and yet per capita consumption remains about 200 pounds. That's 20 pounds lower than its peak in 2007, but that's driven by the fact that we're not producing as much, not that people don't want it. And the evidence of that is this one. look at the prices that they're paying. Demand is the combination of consumption and price. And so when we see strong prices, that can be strong demand driving that. We think it certainly is. As a matter of fact, even if you factor in the reductions of the quantity of product available, these calculations tell us in our demand indexes that last year the demand indexes for all 4 species were higher than the year before. It's the first time that's ever happened. If we look at this year so far, all but turkey up over the last 12 months. If we look at real per capita expenditures last year for all meats, higher than a year ago every month of the year. So far this year we had a kind of a soft January driven by beef and turkey, and I think really the result of bad weather in the East Coast, which really hurt the food service trade, but very strong in February and March. If we look at individual species, here's the softness of beef and chicken the first month of the year. Look where pork has been. We're up 5.2% again this year, where we were up 5.6% last year. So in spite of all those macro conditions that are going to drive income, and the fact that beef prices or meat prices are up higher, more than all the other prices in the economy, the inflation rate was up only 3% last year, that should work against meat demand if our prices are up more than the other prices that the consumers face. And so my conclusion is that consumer preferences for meat are quite strong. They really started growing in 2012. They grew last year. They're growing so far this year. And it reflects a lot of the kind of consumer data that we're getting about people's wanting protein in the diet. I mean, you see a lot more about dietary protein. And what better way to add protein than a pork chop or a steak or something like that? I guess if you have to, you can do it with chicken breast. But, But preferences for meat are certainly look to be much stronger. We've had some debunking, further debunking of the fat issues that we've run into. My doctor says, the medical profession really missed that one, he thinks. He thinks there was a lot of other things we should have been concerned about. And so we see very strong demand. Will that continue? Well, where it's driven by consumer preferences, that can be a fickle thing, but it's certainly on a pretty solid standing at the present time. We're going to skip the economics lesson and go to exports. Now, exports last year pretty soft. They were down about 10% from the year before, but so far this year, year to date, March was up 21%. We're up about 10% year to date. The April data came out this morning. John, I think they were up 10% on quantity. Did you see a value number? Okay, if you can get the value number, that would be helpful, because I think that value number is going to be really high for April. It should reflect higher wholesale prices in March. And to have volume up at 10% at the same time is pretty remarkable. I think that's a great thing for us. I don't know if we're going to get back to this 2007 through 2012 trend, because we were getting new free trade agreements all along here, opening some new markets. There's a couple of things that could do it. The big one that could do it is the successful resolution of Trans-Pacific Partnership that includes Japan and takes apart the gate price mechanism for exports to Japan. That could be a huge shot in the arm for exports. The other one would be the European trade agreement. I'm not quite as optimistic on that one. I don't know if a trade agreement with a bunch of professional protectionists really gives you much help, but we'll find out possibly, and we're probably better off with it than without. But I don't know if we can get back to that kind of trend. We're still exporting about 23% of our production. Good number. If we look at individual markets, a few things important here. One is Mexico now challenges Japan virtually every month as our largest muscle cut market. Japan for a long time was the largest muscle cut market. Mexico's number 2 on byproducts. Put them together, Mexico is our most important volume number. John?
Up until April, we're up 14% in value.
And year to date to April in value. So see, that's an important deal. Exports are up about the same percentage, so great in tonnage. It's been a good year. So that's an important thing here. I think we're going to see Mexico continue to grow. Some people have said, well, Mexico's very price sensitive. And yes, they are, but Mexico also has PEDV in 17 of 31 states, so they've got their own supply situations that they're dealing with. We see the trend of China, Hong Kong, the brown line here, big surges in 2011, but a great month in March for exports to China and Hong Kong, in spite of the fact that domestic prices there pretty low. I think there's a preference for some imported, viewed safe, wholesome product in many segments of that market. The growth of other markets, the kind of aqua-colored line here right with China, that's Australia, Philippines, Guatemala, Honduras, and Colombia are the big ones that are driving that. Okay? They represent a major diversification of our export portfolio, and I think that's going to be real growth as we go forward. Korea's recovering a little bit. We should gain more there with the free trade agreement. And finally, a highlight of this, or a low light, is Russia, which goes to prove that some customers are just not worth having. So, beef and chicken supplies, biofuels, drought, production challenges. The chicken business should be going gangbusters with beef prices where they are, with pork prices where they are. There ought to be a chicken under every rock, and that would be a good place to put chickens, but they're not. They started growing the breeder flock last fall. They haven't grown it very fast. The breeder flock has aged. They grew it just fractionally in April and May. They've really had production difficulties. You can see broiler egg sets up fractionally from a year ago. Chicks placed up, not up at all from a year ago. The ratio of placements to broiler egg sets has been bad since last fall. The eggs aren't hatching correctly. There's livability issues. There's a number of reasons. I talked to a chicken guy a couple of weeks ago. I said, "Why aren't you growing?" And he said, "It's not because we're not trying." They really are putting in an effort, but they're not being able to really grow output. Slaughter is slightly down from last year. Production, slightly down from last year. So I thought we'd have 4% more broilers to compete with this year. We're going to finish the first half at 0. And even if they went to 2% growth for the second half, they'd put them up 1% for the year. So I even think that's probably pretty ambitious at this point. So we're not attracting the kind of attention there. What does that mean? That means chicken prices are back up to last year's levels. They're not lower relative to where they were last year, and I thought in capturing that real advantage in the marketplace, and that helps pork demand going forward, that they haven't responded. Beef is a business poised to grow. Now, I could have said that any of the last 4 years because they've had some pretty strong incentives, but the question is whether they will have the grass conditions and pasture conditions to actually grow. Now, they retained about 2% more heifers for replacements as of January 1. They did that last year too, and those heifers never found it into the cow herd because there wasn't enough grass. The question is, are we going to get enough pasture conditions? Still bad in Texas and Oklahoma, where 25% or so of the cow herd resides, but some pretty good conditions in the northern plains and the southeast. I think the breeding herd is going to grow this year, the beef cow herd, but notice the supplies of all these other calves from last year. Well below a year ago. The calf crop this spring will probably be 2 to 3% below 1 year ago. And if we put all that together, feeder cattle supplies are going to be very, very tight. They were very, very tight on January 1. We placed about 300,000 more cattle in January and February than we did a year ago. So a tight supply. We place more of them. What does that leave you for supply coming up the rest of the year? Tighter yet. So we think that placements are going to be very tight as we go through the summer, setting up another tight beef situation next winter, and you're going to have the same kind of cutout value run-up that we've seen this year. Per capita beef consumption, which is per capita beef availability, down 5% this year, another 3% next year. And, of course, we've had these record cutouts up above $240 a hundredweight for both the choice and the select. They've moderated a bit, but last week we were at $233. We think this is going to go down into the $210, $215 range this summer before rallying back up again in the fall when cattle numbers go down. That brings us to pigs. Of course, the pig story is all PEDV all the time. It's kind of all I've got done the last several weeks and months. This was March 1. And that first week of March, I wrote the article in National Hog Farmer that said, guys, this really looks bad. That's when we published it. And this was what I was seeing at the time. I'd kind of bided my time, as many of you, as we went through last summer. Well, you know, I know this was bad in Oklahoma. We know it's kind of around. We know it has some bad impacts. We think we'll get a handle on it. Well, by January and February, it was pretty obvious we were not getting a handle on it. And we had exploding cases in Iowa and Minnesota. We'd gone out of the regional issue with Oklahoma last summer and then North Carolina in the fall. And so we had a situation where with this many death losses, we were going to have some, it was going to have some big impacts, I thought, come summer. Now, one of the things about this is you can't use the PEDV accession data to do much on numbers because you don't know anything about the farm that's behind that set of samples that gets sent into the animal health lab. So I don't know what the Secretary told us about a monitoring program a while ago. We think that's something he's going to talk about. But it'd been nice to have had a well-designed one a year ago. I guess better late than never. But we need to kind of think this through and make sure we're gathering the kind of data because it sure would have come in helpful here. The thing we did know, at least we knew with some degree of accuracy, was kind of how many sows were being infected. We'd started kind of keeping a count last summer. That got up to about 1 million sows there about December. It started growing after that. We knew also from experience, from talking to managers, that when you had a break, you lost somewhere 2.5 to 3, maybe 3.2 pigs per infected sow. So as I started kind of thinking, it finally dawned on me that, you know, that was where you get the number of pigs lost. We knew we'd lost X number of sows times X number of pigs per sow. And then that they had to be pretty well distributed across time according to these case accessions. If you had more case accessions, you're probably losing more pigs during that time period. And so what I did was take the total, which at the time was about 7 million, distributed them across time according to that blue line there of suckling pig cases submitted per month. That gave me a number of pigs that were lost per month. I compared that to last year's slaughter, adjusted a little bit for death loss to put us back to a wean pig place in the production process. Here would be the raw percentages lost. We know that there's going to be a few culls that are made into market hogs. Okay, so we adjusted 1% there. I figured that there would be 1% lower sow slaughter because of the value of positive sows. We knew that the rest of the herd was gaining 2% in productivity, but the amount of those that weren't infected kept getting smaller every month. So we adjusted for that, and this was what I came up with on the original stab here for the impacts year over year on slaughter, and I was just absolutely shocked. I can tell you that there's never been a spreadsheet at Paragon Economics that's been checked more than that one. I had to make sure this was accurate. I mean, it was, you know, because I came up with numbers that I really was kind of uncomfortable with, and I've said that many times, but I think that they're reasonably accurate. And you know, if that's the case, then we're going to add some weights. We knew that. Probably not quite the 5% that we had last week. I think that's going to get a little smaller. That would put production down somewhere, you know, 7, 8, 9%, and with a price flexibility of 2 to 3, it would be 20 to 25% increases in price, and that's what we published back in March. The next week, or a couple weeks later, Rabobank came out and made me look like an optimist with a 20% reduction in September slaughter. The quarterly hogs and pigs report came out in March, and I was kind of hanging my hat that we were going to get a real good feel here. Analysts thought that we would be down in the 4 to 5, 6% range on most of these market hog inventories. I didn't think that was large enough. USDA came out with numbers that were even larger than that. There are some folks that are still, you know, trading the USDA numbers, and that's their prerogative. I don't think that they're probably very accurate, but we'll find out in the long run. They did pick up some impact here, a huge impact on litter size. And we look graphically, you can see this drop, but I don't think it was really as large as what was out in the field, based on the accession data and my computations. There were some internal problems with the report. If you took the numbers face value, they said that slaughter would be down about 3.5% for the year, and we know that weights were going to be up about 3%, so pork production this year would be almost equal to 1 year ago. I find that hard to believe given how many pigs that I know have been lost. March slaughter was down 6.7%. The 180 and over category was down 4.8%. Those don't match. Now, we know that some pigs were pushed out of March by taking them to heavier weights. We know that. So there was some error there, some slippage there, I think. December, February pig crops, though, for Minnesota, Iowa, and Illinois were estimated at +5, +2, and +3 from a year ago. And I'd traveled quite a bit in Minnesota last winter, and I just could not believe that they had a bigger pig crop this year than they did a year ago, given the death losses. So here's where we are now. That first estimate was made back on March 1. As of May 17th, the new case accessions are down. We thought they would be down because of warmer temperatures, control mechanisms, and ever, but they're certainly not falling off a cliff by any stretch of the imagination. Some states have shown dramatic improvement, Iowa especially, Minnesota to a little bit lesser degree. Illinois finally improved about a month ago. But we need to remember that the pigs being slaughtered now were born right there. Okay? And so all of the losses of the winter are still well ahead of us. And so when I went back and redid this through April, same assumptions, allowing a bit for smaller farms being impacted here since January. I still came up with numbers, double digits for August and September down. And, this assumes 58% of the sows infected. That number comes from the University of Minnesota report that comes out every week of a group of 17 large systems representing 2.7 million sows. It's not a random sample, but it's a darn big one. And so I think it's reasonable. Using 2.7 pigs lost, I've had a lot of people say that's not large enough. I'm making no adjustments for rebreaks. I'm also making no adjustments for the PRRS losses that would have been seen had we not had PEDV present. So that would have kind of mitigated this impact on year-over-year comparisons. And so I've kind of swagged a little bit on my forecast for the third quarter. I don't have it down 14% for August. I got it down 9.7% for the third quarter, which would be those 3 months of the big numbers there, and in some deference to the USDA numbers. Here's where we've been. If you take the right-hand column of those percentage changes, that's this column, and we compare it to actual slaughter and the percent changes we've actually seen. December, pretty close, within 1%. January, actually, slaughter was down a little more than what the computation. February, slaughter wasn't down as much as it was in my computations. But look at March. Actual was down 6.9. The computation said 1.4. In April, actual 5.4. The computations say 3.7. Now, I know March was impacted by this adding of weight. When markets started up, you guys fed hogs another 3 or 4 days and took advantage of that. And that pushed some of these hogs into April. But looks like May is going to be down about 5. My calculations say 2.8. So if anything, so far, slaughter has been down more than what the accession data and my assumptions would have said. I don't think that speaks very well for what's going to happen out here in the summer. It's going to be pretty tight for sure. Sow slaughter, down about 6% year to date. We think there are a number of reasons for that, but gilt retention has not been any higher. There was kind of a surge of gilts in the slaughter mix back in April. There's a little noise in this data series out of Missouri. I don't have a good explanation for that, but in general, we're below the average for gilts as a percentage of the slaughter. So I don't think we're building the herd rapidly, if at all. Positive sows have value. We've had a lot of multiplier gilt units break, so gilt availability is not very good. So we're hoping, that we don't. Well, I don't say we're hoping. We don't think that there's a rapid increase going on. The industry is still looking at PEDV as a transient challenge that we will solve. At some point, that decision may change. It'll probably be next year. I think we're going to see what happens through another winter. But it doesn't look to us that we're building the sow herd now. Of course, weights are making up for a bunch of the shortcoming. Last week, 5% higher on weights. As I pointed out earlier, I don't think we will probably continue that. Number one is you're going to get seasonally lower weights as you go into the summer just because of temperatures. But I think the numbers are going to be so short that to operate these plants at any reasonable throughput level, we're going to have to start dipping deeper and deeper into that supply of market hogs out there and pulling lighter pigs. So my guess is we're going to end up somewhere between 3 and 4% higher on weights this summer, making up for some of this loss in numbers. As far as prices, the right is producer sold negotiated prices. Obviously, the huge run-up in March and April. I can only attribute that to a panic. I mean, the panic occurred over here in the belly, ham, loin, rib market, where a lot of end users read my article or other talk or whatever and says, oh my gosh, we're not going to have any pork. And so they went out, and it was just, for a while, the packers could just name a price and they'd say, we'll take all you got. And that was kind of the way it was. And so it drove this pork cutout value to over 130 bucks. Hogs went right along with it. I think we've seen the high for the year. I don't think we're going to get back here because I don't think we're going to have that kind of emotion in this thing again this year, even though we're going to have some very tight supplies later this summer. If you take from February to right now, if we draw a straight line there, that is a pretty reasonable kind of seasonal rally. I mean, it's pretty much normal. A little higher, but not a lot. But this huge kind of emotion-driven rally in March and April, I think, was really an outlier that we can kind of write off at the moment and say, well, it was an opportunity to make some money if you had hogs to sell. But still, we still have this. We've kind of stabilized here at about $1.12 to $1.15, somewhere around $1.08 to $1.10 on hogs. I think we're going to take these things back up, and we look for prices in August to be up around $1.20, maybe a little higher. My third quarter prices, I think, are $1.12 to $1.20. We'll talk about them here in a minute. Here's my slaughter forecast. Again, I pointed out a while ago, a short 10% lower in the third quarter, and I'm way more bearish on numbers than the other analysts. I believe, they're real scientists, and so they tend to look at the USDA numbers a little more and put more credence, I guess, than in this case I do. And it's not that I don't put credence in USDA numbers. I just don't think they're right on this occasion. And so down about 10%. I've got down 5% for the fourth quarter, 6% for the year. Those numbers might be a little conservative, actually. If we look at weekly slaughters, blue is last year. Black is off the USDA numbers. Red is my forecast, okay, and straight forecast off the accession data. And so you can see quite a difference. I'll take some noise out of that. Green is actual. And so far the USDA numbers hadn't been too bad. It's been under them several times. It's been a kind of over and under mine. Last week, 114,000 short of a year ago and below my estimate for Memorial Day week slaughter. I suspect that we're going to stay, obviously I think we're going to stay near this red line, and the real differences in those are in August and September as we go through that going forward. So prices, second quarter 108 to 112, we're probably going to beat that some because of what we had in April. The average right now to 117. I got 116 to 20 for the average in the third quarter. That would mean some hogs trading in the low 120s, probably in August. You've got August futures. I don't know what they did today, but yesterday they were 127 and change. 128 and a half. That sounds like a dang good August price to me. And I would ask anybody in here, how many of you ever sold any hogs for over 128? That's what I thought. Okay. Now, beyond August, you've got some big spreads. The spread to October is big. The spread to December is huge. We've seen this, though, since the big run-up in the spring. We thought maybe the late summer hogs were a little too cheap, and so it's just kept pushing through the futures complex that the nearbuys are high, and we've got too big a discounts on the deferreds because there are some people think, I guess, we're going to solve this thing tomorrow. I don't think that's going to happen, and so my guess right now is that the summer months are giving you some pricing opportunities. The fall months may be low, and I think I wouldn't go for sure any beyond October and price anything because December could come up pretty dramatically relative to those summer months. So, closing thoughts. This is not a short-term hit. We don't have a proven, effective, consistent vaccine. I've heard mixed results of the Gen 2 vaccine from Harris Vaccines. I've had some people say, it didn't work very well. I heard a producer the day before yesterday tell me that they're seeing some decent results out of it. I hope he's right, and I hope that becomes the real norm as we go forward. We're still asked about what about next winter. We expected the numbers to go down this summer. I don't think they're going away. I would remind you what happened in the Oklahoma Panhandle last summer. It went from farm to farm to farm. They had a lot of wind. That's typical of that area of the world. But it wasn't exactly cold, all right? And it was, matter of fact, it was hot. And this virus did pretty well. So I'm concerned that we won't go down dramatically this summer. When does the industry decide it's endemic and we're just going to have to add production capacity? I mean, that's what, in essence, we did several years ago with PRRS. PRRS just hung around, and so we just had to have enough sows to overcome it. When do we make that decision with PEDV? I don't know. We're only a year down the road. We've got some very good minds working on this. We hope to come up with some solutions. And because that's a huge cost decision. You got the cost of investment, you've got the risk of putting in all those sows and then some darn fool coming up with an effective vaccine. And then we're up to our eyeballs in pigs. Okay? So that's a real risk thing. We need to talk it over. We need to put it on the front burner and talk about those risks as we go through the next 12 to 18 months. But I don't think that decision is going to be made until sometime out into next year after we see what happens through another winter. Beef per capita supplies and consumption probably going to be permanently lower. We've seen this happen in the beef business before. When they cut back on their output, because of their biology, it takes them so long to turn around and go back the other way. And what happens in the meantime? Chicken and pork fill the hole. And I think, we may not be able to participate in that due to PEDV. We'll have to see. But it's going to be tough for them to grow this number back up on per capita consumption. Chicken, on the other hand, a golden opportunity to do that. They're not being able to fulfill that right now. And so this whole protein complex, at a time when protein demand looks to be good, is kind of getting shorted on every front. Turkey production is down 6% this year. Turkey price is record high. Okay? So the whole complex is kind of singing the same song. We'll see what happens as we go forward. Last point, and a point that I've been making too, I guess. Number one is your organizations, the Pork Board and MPPC, have done a banner job of communicating to consumers that this disease is of no threat to them. Okay? They did it from day one. They've done it consistently. They've done it effectively. Now, we want to make sure we give the press some credit. I give the press a lot of blame for things, so I'm certainly going to give them some credit when it's due. They've done a great job of repeating that. Consumers are not afraid of PEDV. That's great, because they shouldn't be. It's an important point. The second point I want to make is this disease has very long tentacles. Here's an example. You've had packing plants in Oklahoma started cutting hours last fall, right, Roy Lee? We've had packing plants that have idled plants for days, a single day a week in North Carolina since March, still doing it today. We're going to start seeing that happening in the Midwest. We've already started seeing some cutting hours. They're going to start idling plants a day, maybe. It depends on their strategy on how to handle these short numbers. But let's put ourselves in Marshalltown, Iowa, or Worthington, Minnesota, or Storm Lake, Iowa, or Ottumwa, Iowa, and let's take 20% of the working hours away from the people that are working in those major employees in those towns. What do you think that's going to do to sales tax revenue? What do you think that's going to do to business volume on Main Street? What do you think it's going to do to all the things, church giving? I mean, we depend on this business, and so there's a public interest in this animal health situation. Consumers are going to pay a lot more money. I've told a lot of reporters the last 3 days that while it's a devastating disease, our producers, this goes against their very being of having pigs die. That's not what we're in the business for. We're going to make more money than we've ever made this year, probably. Most of us. There are a few that won't, but most of us are going to make more money than we've ever made, and we don't like it because pigs are dying. And secondly, because we know we're not delivering as good a value proposition to our consumers as we normally have. We like having high prices, don't get me wrong, but we've got to get back to that value proposition. And so the real burden of this is going to fall on consumers from an economic standpoint. The second one is there's going to be a lot of things in our states and our communities that are impacted by this too. So we're trying to make the case the public has an interest in animal health. We need to make sure we're doing all we can to keep these diseases out of the United States, to manage them effectively and quickly if they get here. And hopefully we can do a better job of that in the future.